Schmidt here, the Tax and Financial Doctor. Well, it's December 2019 and time is running out. If you are a business owner, if you are a taxpayer and you're looking for ways to lower your taxes before the year is over, time is now. There's only a couple of weeks left to get those tax planning moves in place. So I've decided to record a 3-part series of year-end tax tips, year-end moves and strategies that you can use and apply to help lower your taxes for 2019. Now, some folks might say, well, hey, I'm paying really high tax rates. I pay way too much in taxes. Well, that's why you need to take action now. Actually, we're at some of the lowest tax rates in history. Back in the 60s and 70s, tax rates were as high as 70%. If you don't believe me, look it up, but it's true. So what can you do to help lower your taxes? Well, if you own a business, have you reviewed all of the deductions that you could be taking for 2019? Don't be afraid about being audited. Just be accurate. Have good documentation. There are many deductions that I see business owners overlook all the time. You can do things like deduct your health insurance. Now, you may think that is something that's very common that business owners deduct. However, things have to be structured properly. It depends upon whether or not you do own a business, how your business is structured, who's on the payroll. What about out-of-pocket medical expenses? Can those be deducted as well as the health insurance premiums? And the answer to all of those is yes, if it's done properly and with good and proper documentation. How about a health savings account? Those are often overlooked, misunderstood, and complex. What I see people doing is funding them through their workplace plan and then turning around and using the money they've saved right away as a deduction. That's not the best use of your health savings account. It's also not the most strategic way to save and reduce taxes. We've got some smarter ways to approach it. Also, how about Roth IRA conversions? Well, you say, Lynn, if I convert my Roth IRA, doesn't that increase my taxes? Well, yes, it does. However, we are at the lowest tax rates we've seen in history. So why not take advantage of the big gap we have in the tax brackets and strategically plan to lower your taxes in the future when inevitably tax rates are going to go up? But you need to be careful because you can really mess it up and it can trigger other items to be taxable on your return that may or may not have been taxable previously. So again, some good strategic planning is what needs to be done. I've put a link below. If you like what you hear, want to hear some more, check out our future blog posts and give me a call, because here at Lynco Financial and Tax Services, we are trying to help you keep more of what you make and save more of what you keep. Happy tax planning.